So double dipping, you hit the nail right on the head. You are using your money multiple times.
Hmm.
Multiple times. That's unheard of, right? It's like there's no freaking way. That's way too good to be true. That is exactly what we're doing. We're using the money multiple times. All the money is in motion all the time.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Brent Kesler. Brent, how are you doing today?
Hey, I'm doing great, Todd. Thanks for having me on. I'm excited to share with your listeners.
Yeah, absolutely. Well, a little bit about Brent. He is the founder and CEO of the Money Multiplier, and he was a former chiropractor, sold his practices, turned financial freedom. He paid off $1 million in debt in 39 months, and implemented the Money Multiplier method. So, give us a little bit more just about your background, where'd you come from, and then we'll dive in and get really in depth of this Money Multiplier.
Yeah, actually, absolutely, Todd. So yeah, no, yeah. So as you said, I'm a former chiropractor. In my last life, I had five chiropractic clinics in the Kansas City area. I actually sold the last one in 2017. I have not really been practicing in chiropractic since about 2008. I had associate doctors in each of those clinics. So I kind of went down that road. I met my wife here. We've been married about 30 years and went through chiropractic school, as being married and stuff, had kids going through chiropractic school. Wouldn't suggest that if you can avoid that. That's a lot to take on going through, school, especially chiropractic school and having children at the same time. And then, so yeah, now I live in Florida. Home base is Port Orange, Florida, right next to Daytona Beach. I'm about an hour east of Orlando. I was actually raised in Florida. So in 2017, I became an empty nester, my wife and I, and we moved from Kansas City to Florida. And then, believe it or not, the kids followed us down to Florida. Can you imagine that? So anyway,
I
all
can
right, so back
imagine that.
when they
Yeah,
were still in school and I wanted to move to Florida, they didn't want to go because they didn't want to be taken out of their school. But now,
that's too
since I
funny.
moved, they're all in Florida. But today I come to you from the Lake of the Ozarks in Missouri, between St. Louis and Kansas City. I spend my summers up here, usually June through about mid or the end of October in the Lake of the Ozarks here in Missouri. So, but yeah, home base is in Florida. And yeah, that's a little bit about my background. So just to give you a quick idea of like how I get into this thing called the money multiplier, going from chiropractic to like finance. I was at a chiropractic convention back in 2006. And I heard this guy talk about this thing called the infinite banking concept, how to become your own banker. And I was like, man, that is really, really good information, but it just seems too good to be true, right? I'm sure you, Todd, have heard things like that before. You look at something, it sounds good, but you're like, oh, what's the catch, man? It just sounds a little too good to be true. Well, that was me in 2006. I'm sitting in that audience. I heard all the information, thought it was great, but I went home and did nothing with that information, nothing at all. I go back 2 years later to another chiropractic conference in 2008. About 10 or 12 of my colleagues that heard the same information as I did 2 years earlier. The only difference between them and me is they implemented this system, this concept in their financial life. And they were basically ranting and raving, going on and on about how they were building wealth, creating wealth, keeping their money, recycling, recapturing. They were paying off all their debt, all without working harder, changing their cash flow, taking any additional risk. So I thought to myself, there had to be something to this. There's no way 10 or 12 of my colleagues are lying, right? Maybe
Yeah.
one or two, but not 10 or 12. So I came home and told my wife, February of 2008, I said, honey, we have to start implementing this concept in our life. And I was $984,711 in debt at that time, February of 2008. How do
Hmm.
I know? Because that was part of the exercise. I had to know exactly what my debt load was. It was painful to look at, but I had to know. And now you're probably thinking, well, how does a guy from Kansas get to be $1 million in debt? I know if you live in California, that buys a very small
I was gonna say
house,
that's just
or
a
if you pay
small
the
little
taxes
house.
in Minnesota too, that's kind of rough as well,
Yeah.
right?
Oh
But
yeah.
anyway, I had my student loans from chiropractic school. I had my chiropractic clinic. I had two at the time. I also had this house on the Lake of the Ozarks. And if you have a house on the lake, Todd, you have to have a boat and a wave runner, right? You can't have a house on the lake without a boat and a wave runner. I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take a lot to become
Hmm.
almost $1 million in debt. I put this concept into place. I was able to pay that debt off in 39 months, 3 years and 3 months. And all I did was added one step in my financial life. I never had to change my cash flow, didn't have to work any harder, take any additional risk, and I never lost control of my money. So now, fast forward to 2012, I started teaching this concept in March of 2012. Here we are 13 and a half years later, talking to you today. I do 100 to 120 live events, Zoom podcast a year. Have over 17,000 clients in every state of the country, about 150 to 180 new clients a month that that just come aboard with this system and this concept. And all I do, Todd, is I teach and educate. Nobody ever pays me a dime. You guys never pay me a dime. I just pour into you the content and the information. And I'll get into a little bit as we go through this how I actually do get paid because I do like to eat just like the rest of you guys. So, yeah, so that's kind of where I'm at.
It sounds too good to be true.
It is.
Yeah.
I was in the same seat that you were in 2006. Heard the information, thought it was too good to be true. So let me
So yeah,
kind of go into
most of
what.
our listeners are probably a little bit skeptical right now. You know,
Yeah,
you're on the show, you're telling us that you paid off $1 million in debt and uh, just a hair over 3 years, but yet you really didn't change much. It's not like you just were eating rice and beans. Your income didn't double. That stuff didn't change, right?
it did not. I
Okay.
added
Okay.
one step in my financial life. Now, I know your listeners are skeptical because it happens all the time. And I expect you to, well, actually, I kind of wonder what I'm like, why are these guys so skeptical? And then I have to go back and think to myself, I was in the same boat when I first heard the information too, right?
Yeah.
So I have a website. It's called themoneymultiplier.com. Okay. Now I have a full 90 plus minute presentation recorded on that website where I go over the nuts and bolts and everything. But today we're going to go over the high level on the 25,000 foot view. But if you really want to dive in, all you do is you go to the website, themoneymultiplier.com, click watch Brent now, 90 plus minute presentation. I have the examples, the downloadable handouts where I show you exactly how you pay off that debt in much lesser amount of time. And I also show you how to recycle and recapture all of the money that is currently leaving your family. So anytime we spend money, Todd, right? So for example, this is a $20 bill. If I go buy $20 worth of gas, I got to give it to the gas station guy and I get the gas in my car and everybody leaves
Sure.
happy. That's a means of exchange, what
Yep.
money is. I bought his product, gasoline, and in exchange, I got gasoline and he got the money. But because of this concept, I'm able to recycle and recapture that money and use that money over and over and over again. And I believe you told me that, Todd, that just a big part of your audience are real estate investors. Well, let me just tell you, over half of my clients are in the real estate world and are real estate investors. I myself, I own Airbnbs, I own long-term rentals, short-term rentals. I own, and I actually own some raw land. I do a lot of lending. I lend on real estate deals. I lend to big developing communities where people will go in and develop, like 60, 80, 100 houses. I provide a lot or some of the financing for those deals, always in first position. I used to take second position, but now that I'm going to be 58 years old in 5 days, I no longer do second position loans. As a matter of fact, I have a t-shirt, Todd, that says if you're not first, you're last. So I only do first position lending deals. All right. And again, right, not saying there's anything wrong with second position
Yeah,
deals. I just don't want to be behind
you
anybody
just want the less. You
personally.
just want less risk.
Yeah,
Yeah,
absolutely.
yeah,
So this concept called the money multiplier, all right? So, anyway, the concept has been around for over 250 years. So, it's not new. It's not on trial. It's not being tested. I did not invent it. As a matter of fact, so my mentor, he wrote this book right here I'm showing to you called Becoming Your Own Banker by R. Nelson Nash. Now, R. Nelson Nash was my mentor. He passed away about 6.5 years ago in March of 2019 at age 87 years old. This book, this guy completely changed my financial life. So, what I'm going to recommend to your community, Todd, is go out and find this book. Wherever you buy books at, go find this book, Becoming Your Own Banker by Nelson Nash. You want to add that book to your wealth building library. It totally changed my life, and Nelson was my mentor. And now, what I do is I just carry on what Nelson taught me. But even Nelson Nash, Todd, did not invent this concept. No, no, no. If you go back and you do some research on the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, if you really dive into what they did, how they built, kept, and created wealth, this is the concept that they used. Now, also, if you want to go and see how Walt Disney built Disneyland, how Ray Kroc started and funded McDonald's, how Pampered Chef got started before Warren Buffett bought Pampered Chef. This is the concept that they use. So it's not new, it's not on trial, it's not being tested. It's been around for over 250 years.
yeah.
I've just taken it down and broken it down in a very simple, easy to use method. As a matter of fact, Todd, there's a guy out there. His name is Robert Kiyosaki. Most real estate investors know who Robert Kiyosaki is.
Yep.
He wrote a book called Rich Dad, Poor Dad, but he also wrote another book called Second Chance. In that book, Second Chance, Robert Kiyosaki talks about exactly the same thing that I teach. Another guy named Tony Robbins, maybe a few of you have heard of Tony Robbins, he wrote a book called Money Master the Game. In chapter 5.4 of that book, Money Master the Game, Tony Robbins talks about exactly this concept that I teach. Now, those are both great authors. They're both, I mean, right? They're both highly respected in their industry, great books. However, when they talk about this subject, they make it very complicated and difficult to understand. So when the normal reader is reading through it, they see that information and they go right past it. They blow right past it because they really don't understand. And that's just what we do. If we don't really
Oh,
understand something,
yeah,
most of us are too lazy to go back and really try to research it and understand it.
yeah. We're not going to
So
take
they
the
make
time.
it too complicated,
Right, right.
right? So, and I'm sure you've seen that.
Oh yeah.
So I've taken this concept and I've broken it down into like a third grade level of information because I am not a complicated person. As a matter of fact, Todd, it took me 13 trimesters to get through 10 trimesters of Logan Chiropractic College in St. Louis because I kept failing classes. After I finally did pass and I was all done with school, it took me an extra almost 2 years to actually open up my first practice and be a licensed chiropractic physician because I could not pass part three of national boards. And they only give you the test every 6 months. My mom even sent me a plaque, and it's not here, it's at my Florida house. She sent me a plaque with this chipmunk, and this chipmunk, all right, this plaque with this chipmunk, it's gnawing on a piece of wood, and it says a third time is a charm because I was about to go take that test for the third time. No, mom, a third time wasn't a charm. I failed that test 3 times and passed it on my fourth try. Like I said, they only give you that test every 6 months. So I am not the brightest candle in the cake or the sharpest tool in the shed, right? So I like stuff to be broken down very simple and very easy to understand.
Well, let's break it down then. Tell me. I mean, from the start, like what what is this all about? Um,
Yeah.
who is it for? So let's just start. Who is this for? Like, you have to have a certain amount of liquidity, net worth. Like, who is this for?
Yes. So thank you for asking that question because sometimes I don't answer. I just forget. I assume people know that it's for everybody and anybody. As long as you breathe and fog up a mirror, it is for you. I always say this. I say it doesn't matter if you make $10 an hour or $10,000 an hour. Everybody needs to break the bonds of financial slavery they don't even realize they're in and start taking control of their own wealth. So it doesn't matter where you're at on the financial scale, whether you're just trying to get by paycheck to paycheck or you've got massive amounts of income and wealth stored. It doesn't matter because the process, the concept works the same for any individual, for any individual. The only difference sometimes between those individuals is some people put more money into it than the others. But it works the same. The growth on your money is the same. It's just if somebody has a lot of money in it, that means that growth rate is working on more money compared to somebody that has a very small amount of money. It's
Sure.
right. So again, it doesn't matter where you're at. Now, the question that you're wondering is, what is this? What the heck is this infinite banking concept, the money multiplier? Now, I'm going to tell you that in about 30 seconds. But before I do, I'm going to give you a warning. Once I tell you this, we're going to lose about half of the audience that are listening right now because they're going to say, "There's no way. It's too good to be true. It's a sham. It's a scam, or whatever." Here's what I'm going to tell you. Don't take my word on what I'm saying on any of this. Go Google my name, Brent Kesler with one S. Go to the Money Multiplier, Google that. My daughter, my 26-year-old daughter, has a podcast called the Money Multiplier Podcast. She records an episode every week. She's got 130 plus episodes out there now. Go out and look at the plan designs, the case studies, the success stories, the testimonials of hundreds of clients that tell you about how this works for them in their financial life. I cannot convince that many people to lie about this. Maybe a couple people I could, but not hundreds that you're going to find when you go do your research. So don't take my word for it. But the process, the product that we're going to use to build wealth, and here's where I'm about to lose a lot of the crowd. You ready for it? Here it comes. The product we're going to use is a whole life insurance policy in a mutual company that pays dividends. See, Todd, I can see it in your eyes. You almost wanted to turn me off, and you're the host, and you can't. So I said that word life insurance, and that people are thinking, what? Life insurance? Okay, at least those that are still with us that I said that. How in the hell could you build wealth with life insurance? That's a crazy idea. People are thinking, I know everything there is to know about life insurance, and that's a horrible way to build wealth. As a matter of fact, Dave Ramsey and Susie Orman said that would be a bad idea to do that. Well, let me tell you, you do not know everything about this because if you did, you would be implementing this in your own life. Now, I want to be clear, Todd. This is not any type of life insurance policy. No, no, no. No, it's not a term, it's not a variable, it's not a universal, an IUL, an index universal life policy. No, this is not the type of policy that can go and buy from your brother-in-law that sells life insurance. We all have a brother-in-law that sells life insurance. Yes, I know. It is not that type of policy. This is a specifically designed, specially engineered whole life insurance policy in a mutual company that pays dividends that is specifically designed for high immediate cash value. One more time, high immediate cash value. So what that means, Todd, is every time you put money into this policy, you immediately, and my definition of immediately, every time you hear me say the word immediately, it means 30 days. That's what immediately means. Within 30 days, immediately, you have access to the cash value of that policy. And what you're going to do is you're going to use that money to pay everything you're paying for in life now. All your products, your services. I don't care if it's a house, a car, a bicycle, a boat, a pack of chewing gum, anything that you're exchanging money with for, like when you exchange money, you're now going to add this one step. I don't want you to change anything you're doing. Add one step, and that one step is adding where your money goes first. We're going to put the money into this policy first, okay? not a policy with Brent Kesler. You're not going to send it to Brent Kesler, the money multiplier. You're going to send the money to that insurance companies that have been around for well over 130, 150, some over 200 years. Okay. That's where your money is going. Now, remember I said earlier, you don't ever pay me a dime? Where you're wondering, well, Brent, why are you even doing this? How do you get paid? I get paid, Todd, the same way your car insurance guy gets paid. When you go to John Smith, the Allstate agent, to buy car insurance, you don't write a check to John Smith. No, no, no. You write a check to Allstate, and Allstate pays John Smith a commission. No matter who you buy a life insurance policy from, somebody gets paid a commission. Why do you want to work with us at the Money Multiplier and not your brother-in-law that sells life insurance? Is because your brother-in-law doesn't understand this concept. He doesn't understand how to build, design this policy. This is all we do. We are 100% this banking concept. We design this policy this way and only this way. And we also provide you for free. We don't charge you for a dime for anything we do. Everything we do, we give you. We design all your policy tools to allow you to keep all of that wealth inside of your family. That money, it's all in a closed system. That wealth stays within your family. There's no money being leaked out at all, and all the money in your policy is continuing to grow in a guaranteed growth rate plus dividend. Guaranteed growth rate plus dividends. So dividends are above and beyond the guaranteed growth rate because dividends are never guaranteed. But every company I use has been paying dividends for 124 consecutive years plus. But let's just say they stop paying dividends. All right. Let's just say they stop. You still have that money in a guaranteed growth rate environment where the money is growing tax free and the government is completely out of your hair. Oh, by the way, Todd, did I tell you that if you really like government control, that you may not like this concept and what I teach? If you want the government to be in control of your crap?
Yeah, I'm sure that's what our listeners are thinking. Oh man, this sounds like the government can't control me. I don't know if that I want to do this. Um, so the money goes in. So you put the money. Is there when you get the whole life policy? So I'm thinking about a whole life policy. So or traditional whole life policy. So traditional whole life policy, you got to like let's call it a $500,000 of whole life coverage, and you in order to fund that you have to put whatever it is, $6,000, $8,000, $10,000 a year into it. You have a minimum that you got to put into it. Is that the case here? Do you set up a dollar amount and then you have to put a minimum, you have to fund it minimally?
Great question. So, yes, the word you used is traditional. This is far but traditional. This is outside of the box thinking. This is a paradigm shift. As a matter of fact, if you go to whoever your financial coaches are,
Yeah.
your accountant, your CPA, your money manager, attorneys or whatever, and you talk to them about this concept, they don't understand this. So naturally they say, well, that doesn't sound like a good idea. Sounds like a lot of risk. Well, there's no risk whatsoever involved. As a matter of fact, nobody has ever lost money in a whole life policy in a mutual company that pays dividends. Go look it up. You won't find it anywhere. These insurance companies are not federally regulated. They're state, okay? They're state regulated, and they have to go by something called Austrian economics, where $1 protects $1. So it's not like our fractional reserve banking system where a bank can loan 8, 10, or $12 for every dollar they have on hand. As a matter of fact, Todd, if you made a run to the bank today, if everybody made a run to the bank to get their money, you would get about 10, 12 cents of every dollar you would be able to get out because the banks physically don't have the
Yeah.
money.
Yeah.
They
I mean, we
physically
saw
don't
that
have it.
a couple of years
You
ago, right?
can't do that with this concept. Now, to answer your question, does a person say, hey, I want $1 million of death benefit? Yes, you could do it that way, but that's not generally the way we do it. Here's the question we ask. We say, Todd, how much cash value do you want to put into your life policy? So let's just say you tell me 1,000 a month. or you tell
Right.
me 100,000 a month. The number is up to you. I have clients that put in $80 a month, and my largest client, I think, puts in $540,000 a month. So pick a number between there. You pick the number that you want. And the thing is, you tell me that number. Now, how much life insurance does that buy for you? Now, the life insurance is the secondary component to all of this. The life insurance is the secondary component because, Todd, my job is to solve your need for finance and cash. As long as I solve your need and solve your problem for finance and cash, you'll have more life insurance than you can imagine. But the thing you do is you tell me, let's just say you say, Brent, I want to put $1,000 a month of cash into my life insurance policy. Well, Todd, that $1,000 a month is going to buy you X amount of death benefit based on your age and your health. Okay. So let's say you have a twin brother. Obviously, he's a twin, so you're the same age. You both put in 1,000 a month. Let's say you are a super preferred Olympic athlete and your brother's an overweight tobacco smoker. Well, the death benefit, the life insurance value is going to be way less for your overweight tobacco smoking brother than it is for you.
Yeah.
But the cash value is going to be the same or
Hmm.
so close that it doesn't even matter. It's not even worth our time to discuss it, right? The cash value is the same, but the death benefit is different. So that's where I don't ever ask a client how much death benefit that you want. I ask you how much cash value do you want? Now, there are some clients that say, "Hey, Brent, I got to make sure I have at least $1 million or $5 million of death benefit." And if that's the case, we'll design the policy based on that. And it may not be all with whole life cash value. We may do something what we call a convertible term rider. I do very few of those, but if you really need the death benefit today and you don't have enough to cash to equal out what you need in death benefit, we do what we call a convertible term, and now we're locking up your insurability today, and you can always convert that down the road without another health exam. And in most cases, not all, don't hold me to this, in most cases, you have 10 years to convert that.
So how how do you make money on it?
Yeah,
I put $1,000. Let's just say I put $1,000 a month into it.
yeah,
But you also told me I got to use it. So I put $1,000 into it and I'm using it and I'm buying I buy a new car. I'm buying stuff from so
yeah,
I'm
absolutely. And again,
spending
this is how I,
so I'm putting the money into the bank, but I'm taking it out of the bank as well. So what's it doing
yeah.
for me?
Great question. And on that example, when you go to themoneymultiplier.com, you click Watch Brent Now. I
Yeah.
have exactly what you just mentioned, a car example. I show you how I buy cars every 5 years. Every 5 years, it's a $25,000 car.
Yeah.
And I'm not only getting the car, okay, so I'm not only getting the car that I buy, but I'm also getting all the money back too. I'm recycling that money and using that same money over and over and over again to buy the car. So I get the car and the money back also. And I show that example on a $25,000 car. So could I go lower and do a $2,500 computer? Yes, just take off a zero on all the numbers on my example. Could I go higher and do a $250,000 house? Yes, add a zero. Anyway, I have okay, anyway, okay,
Do
so
I
out
have
here
to
at the
have two hundred
airport
fifty
hangar.
thousand dollars of cash to do that?
So, I'm sorry, say again?
So if I want to buy a $250,000 house and I want to buy that house with no mortgage on it, will I have had to put in $1,000 a month to enough to get to 200? Do I have to have the cash?
Yes and no, but not necessarily. Depends on where you're at in the stage of the policy because every year is better than the year before. And I'm going to give you an example. I have
Yeah.
29 of these policies right now. I buy at least one new policy every 1 to 2 years. Okay. So out of all of my clients that have been with me a year or longer, 91% of my clients have more than one of these policies. Now, why do we get more than one?
Yeah.
Is because each policy is a contract. So let's say you tell me, Todd or Brent, okay, the thing you tell me is I want to put in 1,000 a month into the policy.
Hmm.
And now you're putting 1,000 a month into the policy, and then all of a sudden you say, man, this is working good. I want to up that and put in 2,000 a month. You can't do that in the same policy
Ah,
because
got it.
it's a contract you've already established.
Sure.
Now, a long time ago, you used to be able to do that, but in 1988, our good old government came in because anything that's working good for the consumer, the government finds a way to get their hands in it and get some of what you've got, right? So in June of 1988, this thing came out called the MEC limit, MEC. It's called Modified Endowment Contract because you had all these people stuffing all this money into these policies and they were taking advantage of all those tax advantages. So
Yep.
then the government comes in and says, no, 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 no. You can't just go add more money to a policy. So they created this thing called a MEC. Now, if your policy becomes a MEC, modified endowment contract, your policy is no longer treated as an investment. Um, Again, I'm sorry, your policy is no longer treated as an insurance contract. It's treated as an investment and it's subject to that taxation. So, what
Right.
we do when we design the policy, we snuggle it underneath the MEC line and you can never go over it. If you want to go over it, you have to start another policy. I want you to imagine that this glass holds 10 ounces of liquid. You could never get 12 ounces of liquid in this glass no matter how hard you try. You can't do it. It
Yep.
won't hold it. So now we have to start another policy. Now, to get to your question is how much do you have to have in the policy? Well, I can tell you my very first policy that I started when I put in $1 on the first day of the first year, I could not access the full dollar. I could access like anywhere between 55 and 93 cents of that dollar, depending on how we design the policy. Now, there's different ways to design the policy. There's pros and cons to both of those ways, and that's what we go over with you and ask you, how do you want to design? So on day one, I would say, Todd, are you wanting to get, okay, so for every dollar you put in, I'll give you immediate access. Remember, immediate 30 days. You can have either 55 cents of that dollar to use or 93 cents of that dollar to use. The whole dollar is yours. It's yours. It's just you can't use it on day one. Okay.
Yep.
There's pros and cons of doing it both ways. I know the listeners are thinking, well, that's stupid. I would want 93 cents. Well, maybe, maybe not. You got to know all the pros and cons to both of them. So on my first policy, I had the lower amount, like 55, 56 cents of every dollar. That policy that was started in 2008 is now 18 years old. Every dollar that I put into that policy now, this past February, every dollar that I put into that policy, it gave me about $2.78 to use. That means if I put in 100,000, I had $278,000 to use. Now, last year, the number was lower. Next year, okay, this coming February, that number from is going to be higher than $2.78. Why? Because of the time on the policy. Time is your friend. The policies become more efficient with time. Today's better than yesterday. Tomorrow is better than today. That's not my flapping gums. That is in your policy contract. And you see those numbers in your policy contract, Todd, before you ever accept, sign, or pay for the policy. And if you don't see what those numbers are, then you should never accept the policy. All of the numbers are laid out ahead of time so you know exactly what is going to happen. The only thing we never know what's going to happen is the dividend, what the insurance company is going to pay on a dividend. But I will tell you, they track it out and they have a projection of what the dividend is going to be. And they're pretty spot on those projections. Some years it's a little lower and other years it's a little higher. But when you throw it all in the wash, it comes out pretty even.
So if I'm, let me get this, let me make sure I'm getting this straight. Um, let's just use that I put in, I start this policy And I'm going to go with the 50%, 50 cents. Um, and I throw in, let's call it $20,000
Hmm.
a year into this policy. In year one, if I throw in 20,000, I can only, I can, I have some cash value, but I can utilize only about $10,000. Is that right?
So the cash value you're going to utilize in year one is all depending on all depending on how we design that policy. It's going to be between 55% and 93%
Yeah.
is what you're going to get immediately within
Yeah.
30 days. So
So,
anyway, so let's just
so
use
rough,
10,000
roughly
for
within
easy
30
math.
days of that, I can access about half, maybe a little bit more, depending on, like you said, depending on how it's designed.
Yep.
Um,
But it's all your money.
but it's still my money, and eventually that the rest of it's accessible too. And then that money's growing, so that money's getting dividend. The
All
following
the money is
year,
growing, Todd, even though when you use that money to buy real estate or buy a car or anything at all, you never take the money out of that. Okay, the thing is, you never take the money out of the policy. So that means you're still getting the interest, the dividends, the guaranteed growth, and you're using your money at the same time. There's
so
no other
it's
vehicle on this
getting
planet that you can do that with.
it's getting treated. So if I do this, okay, let's just I put in 20 grand this year, put in 20 grand next year, put in 20 grand, 20 grand, and now I'm at 100 grand, and I can access a big chunk of that money. Maybe I can access up to 75,000 of that money. And I take that 75,000 and I go use it for a down payment on a rental property. I am getting paid based on having $100,000 in my policy, but I'm also getting the benefit of owning this duplex and getting paid for this duplex. So I'm kind of double dipping. Is that accurate?
You are absolutely double dipping. We have podcasts and episodes
Got
and
it.
trainings that show you a double dip. I'm going to give you an example. There's a client who's now a colleague of mine. His name is Devin Burr. Devin Burr, Burr. He lives in Phoenix, Arizona. He's a real estate investor. Devin has lots of things out there on social media, TikTok, Instagram, Facebook, all that stuff that I don't know how to use most of it. But he has lots of content out there and he shows you exactly how he buys all of his real estate and he uses the same money over and over and over again. So double dipping, you hit the nail right on the head. You are using your money multiple times.
Hmm.
Multiple times. That's unheard of, right? It's like there's no freaking way. That's way too good to be true. That is exactly what we're doing. We're using the money multiple times. All the money is in motion all the time. It's not stagnant. See, Todd, here's what we've been taught to do. We've been taught to go get a job. We've been taught to work hard. We've been taught to maximize our 401k, our IRA, our qualified plan, our mutual funds. Go get a financial advisor, an accountant, an attorney, a money market guy, whatever. Anytime that you go into a conventional bank, there's a room in the corner. It says, "Come here to invest all your money." You know, those guys that will lose it for you. I wrote a book called Mapping Out the Millionaire Mystery that I'm going to share with your list. I'm going to give it to all your listeners, the ebook version. In this book, I talk about a guy named John that works out at my community airport. He went into one of those offices in the bank, gave him all of his retirement money to be called less than a year later and said, "Hey, John, I'm sorry, but we've lost 94% of your portfolio. It's gone." And now he's out there pumping gas in my airplane at the Camdenton Municipal Airport in Camdenton, Missouri,
Hmm.
just so he can survive. By
Wow.
the way, on
That's
this
sad.
book that I'm going to give you, okay, I wrote this book, Mapping Out the Millionaire Mystery. The guy I wrote it with, his name is Chris Naugle. A lot of you may have heard of Chris Naugle, especially if you're in the real estate world. If not, go look him up, chrisnaugle.com. He lives in Buffalo, New York. Very active in the real estate world. He had a TV show on House Hunters, another one on HGTV called Risky Builders. Chris does content 5 to 6 days a week on this method that we're talking about.
Hmm. That's great.
Great
Um,
resource.
if I've got a traditional whole life policy. Could I take that traditional whole life policy and move that into this non-traditional?
Great question. And the quick answer is yes. Now, there's different types of policies, okay? Everything we deal with is whole life policies in mutual companies. So a lot of people tell me, yeah, I have a whole life policy, but they actually have an IUL, an Index Universal Life Policy. I could make a really nice commission if you would buy an IUL policy from me, but I would never buy one myself. So that means I would never sell you an IUL policy. You do not want to use an IUL policy for this concept. You do not. A lot of people will tell you that you can, but I've got hours of content that show you why you do not want to do it because you
Hmm.
can lose every single dollar. Why? Because IUL, I stands for what? Index. What is index? It's based on what the stock market does. I don't have a dollar in the market. I don't have $1 in the market. I don't have any cryptocurrency. I have some gold and silver that I don't even know why in the hell I have it. I'm too lazy to get rid of it that I've had for years and years and years before I ever knew about this concept, right? So you want this in a cash value whole life policy in a mutual company that pays dividends. But if you have a whole life policy or even an IUL, the thing we can do is a couple of different things. One thing is we can do what we call a 1035 exchange by exchanging your current policy into a new policy, almost like a 1031 in real estate, right?
Sure.
Kind of similar to that.
Yeah.
Now, let's just say that you have a policy already, and a lot of people have these, Todd. They have whole life policies um, that are great policies, and they don't even know what they have. You're from Minnesota. There's a guy up there on the lake. His name is Eric. Is it called Lake Minnetonka? Lake
Close.
Minna?
Lake Minnetonka.
Lake Minnetonka. Big lake. He got a big old boat or whatever. He reached out to me one day. I actually went to his house about 4, 5, 6 years ago. Him and his wife were clients. Um, he had these life insurance policies and he had hundreds of thousands of dollars of cash value and they weren't even designed correctly. However, because of the age on those policies at that time, they were great policies. Any policy that's a whole life policy, even if it was poorly designed from the get go, even if it was poorly designed, if it was a whole life policy with age, it has cash value. And I would never tell you to quit that policy. You want to keep that policy and let's use it. In other words, here's what Eric had. Eric had the Corvette in the garage, but he had no idea where the hell the keys were.
Yeah.
Didn't know. Didn't know where
Yeah.
the keys were. So it
Yeah.
was sitting in the garage.
Just collecting dust.
Lake Minnetonka.
Yeah. It's a beautiful lake. It's a
Oh,
busy
it's a
lake.
beautiful lake.
All right. I know both of us are needing to wrap up. There's been a lot of information here, and there's a ton more we could really talk about. So
Let's do a
people,
part two sometime.
well, they're going to have to go to the moneymultiplier.com and learn more because there's a lot here. I got a couple last questions. You've mentioned a few books. Besides those books, what's a book you can recommend to our listeners? Something that you enjoy, that you think our listeners would enjoy as well.
Yeah, there's a couple books. Actually, there's a guy named Dan Sullivan, but the guy that wrote his books was Benjamin Hardy.
Yep.
The name is escaping me right now, but just go look at the books by Dan Sullivan, but Benjamin Hardy wrote. Um, it's about, I think it's called Who Not How.
Yeah. You know,
Is
it's a great
one.
book.
I like anything that the late Zig Ziglar has out there. I love Zig Ziglar. I'm a
Mhm.
big believer, and I try to live by this every day of my life. And Zig Ziglar says, help enough other people get what they want, and you'll end up getting what you want. So it's my mission to serve people, to serve you, to serve your community. And all of our content, which we upload new content all the time, every week. Like I said, Chris Noggle does it 4 to 5 to 6 times a week. All of our best stuff we give away for free. We give everything away for free. All of our content we give away for free, so it's out there. And I would also say three things I would tell your listeners. Pay attention, get excited, and never quit. Pay attention. So if there's something that interests you, Pay attention to what's going on in that thing that interests you. Try to get excited about it. Go into it with a positive attitude and never quit. And then if you do quit, throw it out, never look at it again, and don't go back to it. And three other things I would say is I would say mindset, systems, and mentors. It all starts with your mindset. It's all what's between your ears. You know, God gave me two ears and one mouth, so I should be listening twice as much that I talk. I'm still trying to learn that trait at 58 years old. I haven't learned it yet. So, mindset, systems, have a system, a process, a protocol. The money multiplier system is a system to help you build, keep, and create wealth through your own debts and expenses that you already have. If you know of a better system that has these features and benefits that what I'm sharing with you, please tell me what it is because I've been looking now for almost 18 years and nobody has been able to show it to me. So, mindset systems and mentors. Find a mentor, find a mentor and a coach that will help you get through all of this. Last quick story. I was in Ireland last year. I was in a golf pro shop, and this guy was out there in the golf pro shop. And I said, how come you're here? He says, I got a client and I'm teaching him how to fly fish. And okay, well, how come you're here? He says, well, he likes to golf and fly fish. Who's your client? His name was Mark O'Meara. Mark O'Meara, the golfer. He was teaching, so he had a coach. And then he told me, and we talked for about 10 more minutes. And he says, and I told him that I had a house in Island Park, Idaho. And he said, Island Park, Idaho, that's some of the best fly fishing in the country or even the world.
Yeah.
Island Park, Idaho is great. He says, as a matter of fact, I taught Tiger Woods how to fly fish in Island Park, Idaho. So Tiger Woods didn't go out there on his own and start throwing a cast and just say, hey, I'm going to go fly fish. No, he had a teacher, a coach, and a mentor. So whatever it is that you want to do and be successful, you got to have a teacher, a
Yeah.
coach, a mentor. A lot of us are too big in the head to think, oh, we don't need a coach or a teacher. I can do this on my own. No, man. Get it. Find someone that's a mentor to you in
Yep.
anything that you're doing. I'm a big believer in that.
Love it. Love it. This has been good stuff. Brent, really appreciate you. Appreciate the time. How can our listeners get in touch with you? Learn more about what you got going on.
Yep. Our website is themoneymultiplier.com, www.themoneymultiplier.com. Go watch that 90-minute video. Watch Brent now. We also have 70 plus other videos on there. If you want to send me an email, Brent, B-R-E-N-T, Brent at themoneymultiplier.com. I'll send you the ebook. And then also my daughter has the podcast, the Money Multiplier Podcast. Just go to wherever you find podcast at and just find the Money Multiplier Podcast. Her name is Hannah Kesler. And again, I speak around the country, 100 to 120 events, live, virtual, FaceTime, podcasts, webinars. So if you know anybody that should hear this information and they're looking for a speaker or a sponsor,
There you go.
call me. Let's talk.
Love it. Love it. Again, Brent, really appreciate you. Appreciate the time. And man, listeners, there's a lot of good stuff here. A lot more to dive into. So go to themoneymultiplier.com, learn more about it. Get the what was the Infinite Baking book that you
Oh
mentioned?
yeah, it's a book called "Becoming Your Own Banker"
Become Your Own Banker.
by R. Nelson Nash. Now, I'll tell you, he wrote two other books as well. But if you can only afford to go buy one, get this one. This is the Bible of financial. This
That's
is
the
a book
one.
that you got to add to your financial library. He
Love it.
also wrote this one, The Case for IBC and Building Your Warehouse to Wealth. He's got three books out there, but this is the Mac Daddy of them all right there.
Love it. Brent, you have a fantastic rest of the day.
Thank you. See you.
See ya. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So The other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.